Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. 'Tis the season, and today we're looking ahead to 2026 and market seasonality with today's guest, the man who keeps Wall Street's calendar. And our phrase of the day is the Santa Claus rally. Even if you've heard of it, it might not be what you think it is. We'll break down this indicator straight from the source. And today's market show and tell, we're going to put up the MACD, a simple momentum gauge to see what it's really saying about this rally and whether or not it's running hot. And this episode is brought to you by the number 12%. That's our guess upper end range for the S&P 500 in 2026. 2025 is defying odds. Can 2026 keep up the momentum? And today we are welcoming back for the third time Jeff Hirsch, who is the editor-in-chief of the Stock Traders Almanac and son of Yale Hirsch, the market historian who literally wrote the book on seasonality, putting together the very first almanac in 1968. For more than 5 decades, the Hirsch playbook has tracked how certain days, months, and election years have quietly tilted the odds in favor of investors. And now Jeff is applying that toolkit to everything from holiday spending to today's AI-fueled super boom. So Jeff, let's start with how things are going this year, which is actually pretty good. Lots of surprises, but pretty good in the end.
I mean, considering the big...
Knock on wood.
considering the big tariff tumble we had, kind of a reset. I mean, we're at the upper end of our best case scenario for 2025. It's pretty impressive. The market's been able to tack on more gains like this third year in a row.
Yep.
It seems like all we've been talking about, though, is this AI-driven boom in the back half of the year really leading to these high year-end expectations. Do you think it's just that, or break it all down for us?
Well, I mean, it is a lot that. Interest rates are coming down. The economy's doing well. But, I mean, this is one of those generational booms. This is... I wrote a book called Super Boom, and this AI technology is that kind of culturally enabling paradigm-shifting technology, like the microprocessor, like the car, like the interstate, highway system, the fire, the wheel, indoor plumbing, the combustion engine.
I'm excited.
Yeah.
This is one of those.
Comparing it to that?
Yeah, I mean, this is one of those things that potentially, and I feel like it is impacting everybody individually and the whole world collectively, and that's what drives these booms. It might be a setback here or there, but I think it's early innings.
All right, with this momentum, time now for our phrase of the day, the Santa Claus rally. This is literally a Hirsch family indicator, so let's break down what makes it an indicator. Well, it tracks the S&P 500 over the last 5 trading days of December and the first 2 trading days of January. How that 7 stretch performs can say a lot about the year ahead, and Jeff bundles it together with 2 other measures. He watches closely into what he calls his January indicator trifecta. So Jeff, break it all down for us. What is this January indicator trifecta?
Well, I mean, hats off to my late father, Yale Hirsch, creator of the Almanac. In 72, in the 1973 Stock Traders Almanac, he invented the Santa Claus rally and the January barometer. Not to be confused with the January effect. January barometer is as the S&P 500 goes in January, so goes the year. That's the full month of January. Santa Claus rally, as you correctly described it, is the last 5 days of the year, first 2 of the new year. It's an indicator. It's not some year-end trading strategy. And what happens during that period of time is usually a lot of people are off and the pros are in there picking up bargain stocks were sold for tax loss selling. And the market tends to be up a modest 1.5%. And when it's not, it's an indication that there are other forces that are at play, that things might be awry. So as Yale, the phrase that he invented or that he coined was, if Santa Claus should fail to call, bears may come to Broad and Wall. And for youngsters, Broad and Wall is the intersection in New York where the New York Stock Exchange.
Wall Street and Main Street. We love that right here on Stocks in Translation.
So it's important. The January trifecta. We take stand on Yale's shoulders. We put the first 5 days indicator, which is another indicator, in conjunction with the full month barometer and the Santa Claus rally. Pretty impressive results there.
Yeah, so you can actually, by the end of January, we have a decent idea of how the year is going to end, and we actually get a couple indications in early January. So that's why I think you talk about it as an indicator. Let's back up, get big picture for a second. You said it's not a trading strategy. How should investors be thinking about seasonality? Because I've heard, and some of my own work shows like it has about it can drive about 1/3 of the market returns, but really not more than that.
It's a factor. It's one of the things we look at. I look at fundamentals, technicals, monetary policy, sentiment. So it gives you a little bit of an edge. And the thing that's important when seasonality is not working, kind of like the crux of the Santa Claus rally, is that it's an indication other forces are there and the other forces are stronger.
Like Liberation Day, too.
Like Liberation Day, like AI booms, like, the bounce back, like the whole sell in May period was great this year. There's an indication that there's really strong underlying, fundamentals going on. And also when we cleared some of those resistance levels, technicals, overrode the seasonal week period. So this is why we look at history as a guide. It's not gospel. I mean, nothing works 100% of the time. I mean, they say if you're right 60% of the time in the market, that's what you want to be. So we look for seasonal patterns that work or that have been consistent 60+% of the time. The little bullish and bearish days in the Almanac is the days that the S&P has been up or down 60% or more of the time on that given trading day, using a little bit of our proprietary analysis.
For young investors who are looking to get in, and maybe they're hearing for the Santa Claus rally for the first time ever, and you say it's a slower week, that last week of trading, should they jump in or should they look around? Should they seek this out? Where do they even begin during those slower days?
You want to be in ahead of it. The fourth quarter is the strongest quarter. November, December, January, the 3 strongest months. So we like to get in October when we see a turn. Another one of Yale's, discoveries was October is the bargain month, the best time to buy stocks, where we see bear markets bottom a lot. We had a nice bottom in 22.
Yeah, so hope everybody's long already.
You should be long already. And that's what we advise our subscribers or our members.
All right, I want to shift gears for a second because on today's Market Show and Tell, we're digging into the toolkit with MACD, or Moving Average Convergence Divergence. It is a mouthful, but it's really just a way of comparing short-term and longer-term moving averages to show when a trend is strengthening, fading, or about to turn. You can use it for free on the Yahoo Finance app or site, that's MACD, and usually you see MACD in 3 different parts or lines. The MACD line itself, which is the gap between those 2 moving averages, plus a smoothed signal line that lags it, and then there's usually a histogram of vertical lines that shows the distance between those other 2 lines. So you put it all together, it can look like a big jumbled mess unless you're used to looking at it. But tell us how you used it. You mentioned October, like a signal turning. Is the MACD involved in that?
Most definitely.
Yeah.
It really adds to the consistency of the seasonality. It improves the results tremendously. So the best 6 months, another Yale discovery, November through April. If we use MACD to get in early and get out earlier or later and get out earlier or later, it helps with your entries and exits. It improves the results several-fold. It turns, what's a 7.4% gain to like an 8.9% gain. And if you compound it with, compounded annual growth, it's much more impressive. So what we do is we look at more than one kind of MACD. Now, these are moving averages. They're exponential moving averages. Exponential moving averages is a moving average that puts more weight to the most recent data point.
So it moves faster.
It moves a little fast. What's a little more weighted towards the present as opposed to the past. And, everyone looks at 12-26-9, which is a 12-day minus a 26-day with a 9-day moving average of the difference. 3
different settings for MACD. Those are the ones you just laid out that are usually there, the defaults.
We use that for the sell side because it's a little bit longer, and we'll start looking in April, and because tops tend to be a process, they take time. But for our buy point, like what we had in October, we look at the 8-17-9. It's a shorter, faster MACD. Gets you in because bottoms tend to be a little bit more of an event, happen a little faster. And these are the original settings from the guy who invented MACD, Jerry Appel, another late great guy. And it's one of the classic, one of the most effective technical analysis tools out there. And it works really well in conjunction with our seasonal switching strategy, the best and worst 6 months of the year.
I think that if someone does want to get involved, maybe they want to jump in investing right now, they hear this and they're thinking, well, there's those certain things that happen, like the AI boom, like this Liberation Day, and that really spooked so many people on Main Street looking to get into Wall Street. So how do you sort of use this to sort of go around these mega days?
Yeah, I think like as an investor, you pull up the Yahoo Finance site, there's a lot of indicators.
Yeah.
And we say, okay, look at the basic ones, the MACD one. But how do you begin?
You can begin with the Almanac. It's in there. It's sort of made for beginners. It's on the desk of top managers. It's also great for people who are just starting out. We explain the MACD, how we use it with the seasonal strategy as well in there. I mean, start with the Almanac. Read my intro, read the outlook, go to the back of the book and look at some of the explanations of, how to, profit from your own mistakes, how to write things down and keep track of things. I mean, it's built for you to take notes and write things down and keep track of what you're doing, especially in this digital world. It's nice to have something analog you can carry with you and put pen to paper with.
Yeah.
So, you got to do a little research. Read up on MACD.
Right.
I want to come back to the time of year that we're in right now, because this tends to be the time of year when small caps, outperform. So you got smaller caps, they tend to do a little bit better. And I remember like last week or 2 weeks ago, we had a 5-day stretch when small caps rallied, like Russell 2000 was hitting a record high. So tell us about the seasonality of that.
Sure.
One market versus the other.
Yeah, something called the January effect, which used to be the tendency of small caps to outperform large caps in January. We've seen that shift into the prior year. Most of it happens the last 2 weeks of December, but as you're pointing out, it does tend to pick up around the end of October and around Thanksgiving in November as well. And we're seeing that. So the pattern that we illustrate is we look at the middle of the year. It's the Russell 2000 versus the 1000, and we're seeing it start to track that, and that seasonal, bullishness of small caps starting to stir here. Looks like it's pretty good, but it kind of ends mid-January into February a little bit, so you want to be careful not to ride it too long.
Gotcha.
Jeff, we do need to take a short break, but coming up, we're talking 2026 predictions and who wore it better. Stay tuned. This episode is brought to you by the number 12%. That's the upper end of Jeff's S&P 500 forecast for 2026. Now, the lower end is 8%. So all in all, not bad for year 4 of this bull market. And Jeff, I know you're looking at 2026 in the context of the 4-year presidential cycle. So walk us through this base case that you have.
Well, I mean, midterm years are notoriously the worst year of the 4-year cycle. We had the bear market in 2018. But we did have a reset earlier this year with the April tariff tumble, and a bunch of technicians, as we've spoken about, thinking that's a reset, ourselves included. So what might normally be a bearish year for the midterm year might be a little more bullish, especially considering the AI boom that we're talking about and the reset that we had. So while we do expect some weakness Q2, Q3, which is the weak spot of the 4-year cycle, Q2, Q3 of the midterm year, that sets up the bottom picker's paradise. Another one of Yale's phrases, the sweet spot of the 4-year cycle, the 3-quarter combo, Q4 of the midterm year to Q2 of the pre-election year, potential for a 50% gain in the Dow, even more like 67% for NASDAQ from the midterm low to the pre-election year high. But thinking about all of the fiscal stimulus, the big beautiful bill, the deregulation, the easy Fed, and the reset, sort of shifts our midterm outlook a little bit. It's been shifting as we're still putting together our final forecast for 2026, but it's shifting a little bit more bullish to that sort of 8 to 12%, with maybe dipping a little bit negative, or at least getting close to the zero line in the middle of the year around Q2, Q3.
All right, so maybe a little bit of trouble in the middle of the year, but coming out strong once again. I want to focus on what you just said, that reset. And of course, we're talking about in April of this year, we had that post-Liberation Day sell-off, and it was very short-lived. And before you blinked, we were back up at record highs.
Right.
And the nature of a bear market is that it is a reset. And while this technically wasn't a 20% decline in the S&P 500, so you didn't see any bear market headlines, it sure felt like one. And so talk to us about how these resets can set up kind of a brand new cycle, and maybe we're in the first year of a brand new bull market.
Arguably, we may very well be. We're in the middle or the early stages of the secular bull market, which is going to go on for a while, I expect. That reset, I mean, if you think about what the VIX did, over 50, I mean, you're talking about that fear spiking. We may need to reset, like the world needs new models. The Fed needs new models. Maybe us market and analysts need new bear market models. I mean, if we use the Ned Davis research models, which is like 13% over 145 calendar days, or a reversal of 30 in the value line, whatever, or when people look at the 20%, which is arbitrary. But as you're saying, it did feel like a bear market. It was quick, but the fear was rampant. The selling was rampant. And once we came out of that and busted through all those resistance levels, perhaps, a little hindsight we'll need to see if it really was a bear market and if we're in a new bull market. But the market's behaving like it is, so, don't fight the tape.
And what did this sort of prove to you? Because you're saying don't fight the tape, but this really had Main Street really concerned. I mean, people were so fearful of their 401ks. Everyone's telling them not to look. So did this kind of just prove stay long?
I don't know if it proved stay long. It proved by the VIX at greater than 50, by the market when the VIX hits greater than 50. It proved don't sell at those bottoms, but there are times to not be long. It proved to not react, to not be emotional when the market's down like that. That's not when you sell. You want to be getting out more, calculated at upper levels, of the market. So when the market sells off like that, that's not the time to sell.
Yeah.
Stay long then, but not necessarily 100% of the time.
Right.
Jeff, you said something really interesting. I just want to touch on this. Don't fight the tape. Now, a lot of us have heard don't fight the Fed. And I think don't fight the Fed and don't fight the tape were both part of Marty Zweig's, his rules. And don't fight the Fed was farther down on the list. You actually don't want to fight the tape. That was his number one. That is what price action is doing right now and in recent history. So talk to us about why that's important over even the Fed.
Well, I mean, the market is the final arbiter of all things. It is the greatest indicator and barometer. I knew Marty as a kid. He was a brilliant guy. I had the chance of being at his place, and he and Yale exchanged ideas, and he was part of the Almanac, development as well.
So you were sitting in your living room with him as a kid.
I was in his living room. I was talking to him on the phone and his people. I don't think he was ever
in your living room.
But I was in. He had a party for the the American History Museum of Finance, which was a nice event that we were at. But don't fight the tape is all that really matters. It's all on the charts. Everything's figured in there. The market is not emotional. So if it's continuing to go up, I mean, there's another little thing that we put out. The 7 months in a row that the S&P's been up. It usually leads to gains further 6 months out. This is the sort of gains be it gains, that momentum. We're in that seasonal sweet spot of the year as well. So don't fight the tape. Don't fight the momentum. We got the Fed easing as well. There's a lot of positive things right here coming into year-end 2025.
That's optimism.
And it sounds like these are a bunch of bullish things. And so sometimes you want to lean contrarian, but I would add that there's still a lot of doubt about this bull market. And there are plenty of reasons, we're not necessarily going through all of them today, that there is kind of a bearish cloud over certain parts of the market. People doubt the strength of the AI story going into next year. There's some concerns, is the Fed really going to cut? Is all that getting baked in right now? So I think, all in all, there are still some bearish overtones, and just happens that what we're talking about is mainly bullish today.
Yeah.
But what do you think about that?
That's that wall of worry. The AI trade is a little overbought. Was more of a bought before. Will probably correct a bit, but there are, with that concern there, that skepticism in the market. It's bullish. There's bears on the sideline. I mean, kind of like the disconnect between the consumer sentiment readings we've been hearing recently and then the consumer spending that we've been seeing recently. There's just, people are talking about being afraid, but they're still buying the things at the holiday sales and holiday purchases as well as stocks. So
National Retail Federation says $1 trillion.
Exactly.
That's how much consumers are supposed to spend this holiday. I mean, that would be record. So it goes to
it's
show
not
that.
what they say, it's what they do.
Exactly. And sometimes the disconnect is fuel itself. Now we've got a classic markets take on a Hollywood gab show staple. Who wore it better? Central Banker edition. And today we're rolling back history to the early 1980s to the Volcker Fed first, famous for beating inflation back by raising short-term rates to 20%. Ouch. We're calling him the silent enforcer and comparing his era to today's much chattier Powell Fed. So on the left runway, you've got Paul Volcker, towering. He was a tall guy. 1980s power suit. Thick frame glasses. The look is heavy, no frills, almost austere. This is the Fed that mostly let bond markets speak and only stepped in with big, painful moves when inflation got out of hand. On the right catwalk, we've got Jerome Powell. In a modern suit with a slimmer cut and a dot plot tie, he inherited a much more talkative Fed and is used to leaning forward into forward guidance. So managing expectations is as important as the actual rate cutting or rate hiking. So, Jeff, who's wearing this U.S. Central Bank better? The quiet, blunt force of Volcker and his silhouette, or the highly styled, always chatty Powell figure?
Well, Mr. Volcker does get the benefit of hindsight, but I would vote vote Volcker. And I think it has a lot to do with what you said about the chattiness of the current Fed and what Powell inherited.
Which began with Bernanke, maybe even, not Greenspan, but Bernanke.
Well, Greenspan was talking irrational exuberance, way back in '96. But the Fed was created to be a guardrail on the bond market and to listen to the bond market. And over the past several decades, it's become a forecasting body as opposed to a monetary policy, adjustment policy. With there's some quote from one of the minutes back in '81 when Volcker's Fed, and they were talking about that if the range, if the bond market gets out of the range of 15 to 20%, big range and high interest rates, then we'll make some adjustments. So they were talking about watching the bond market and going in there and making some adjustments to react to what the market was doing, not dictating what the bond market could do or should do. So I think we're going to get back to some of that older school Fed where they're sort of following the market.
Swinging too far one way. Yeah.
Agreed. And they need to stop being out there talking so much and giving speeches. Coming up with some new models.
I was going to say, with that being said, now we're hearing so much more. Even the CME has the Fed Watch tool, the rate of a likelihood of a rate cut this week is about 90%. We also have prediction markets now, even, and you roll your eyes, but they're even, predicting whether or not we'll get a rate cut.
FanDuel for the stock market.
I mean, all this.
It is what it is. This is a new retail trading market.
This seems like the new metric people are going by. I guess with all this outside noise, how do they sort of stay focused in, and how important is that?
Turn it off. Put your phone down. Just look at the
focus on the fundamentals.
Look at the tape.
Okay.
I mean, you're talking to a CMT. I don't know what kind of answer we're expecting. You can look at the tape, but no, I think there is really it does come back to price action and can you read a candlestick chart? And I'll always go back. I love candlesticks because it's telling you where the levels that you need to watch are. They just scream at you, and you look at them for a while, and you can just see the emotion in the chart itself. There's the greed, there's the fear, there's the worry, and here's the bounce back. So, and there's that wall of worry. So. We got to leave it here, Jeff. It's always great talking to you, and best of luck with your year-end sprint here. And thanks for taking the time to come out. Just to go back, we talked a lot about seasonality today and how the Santa Claus rally is really an indicator. What happens at the end of this year and through the end of January can tell us a lot about what we can expect for next year. Notwithstanding that, Jeff wasn't shy about his prediction, 8 to 12% in the S&P 500. He's still working on that. And I would really love to have another conversation with you, Jeff, about whose living room you got to visit when you were a child or who might have shown up in yours. Marty Zweig is a really big one, so that's pretty cool. And we have officially wound things down here at Stocks in Translation, so be sure to check out our other episodes of our video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms, so be sure to leave a comment, and subscribe wherever you get your podcast. We will see you next time on Stocks in Translation.